If you have ever wondered what it takes to attract private investors or how to present your business with confidence, you are in the right place. Private funding through angels or VCs is partnership capital that helps you scale without immediate repayment. For example, a small software startup was rejected for a bank loan because they lacked collateral. Instead, they pitched to a local angel group, raised $100,000 for a 10% equity stake, and used it to build their prototype. 6 months later, they qualified for a larger VC round. That's the kind of leap we are talking about. The bigger message: when you think like someone preparing for investment, you track metrics, tighten operations, and communicate value clearly. Those practices make your business fundable and sustainable, whether you raise money or not. As we move forward, keep asking, how does this apply to my business today? Here's our roadmap. First, we'll clarify the capital landscape so you can see where private funding fits. Then we'll break down what investors evaluate: traction, scalability, and risk. Next, we'll cover how to craft a compelling pitch, check your fundraising readiness, and finish with actionable next steps. Let's understand the angel investor mindset. Angels are individuals who invest their own money in early stage businesses. They are often former executives or entrepreneurs who want to pay it forward and, yes, make a return. They look for passionate founders, early traction, and a clear path to profit. For example, a local logistics startup raised 50K from a retired trucking executive who understood the problem firsthand. His money helped, but his network of fleet owners was even more valuable. That's the power of smart angel capital. When approaching angels, lead with your story, your numbers, and your purpose. They back people they believe in long before the spreadsheet makes perfect sense. To summarize, angels invest personal funds, focus on early traction, and strong teams often provide mentorship and connections. Drop your biggest growth question in the chat and I'll answer them after today's session is over. I'll message you on LinkedIn. Going into the VC mindset, it's pooled money managed by professional investors who aim for big scalable wins. VCs look for businesses that can grow tenfold or more in the first 5 to 7 years. Usually tech enabled, but not always, and definitely repeatable and defensible. Think of a regional e commerce startup that started small in handmade goods. Once they built an app and doubled user growth quarter over quarter, a VC fund stepped in with $1 million seed round. The deal wasn't about today's revenue, it was about the growth curve. If you're pitching VCs, focus on scale, team capability, and market potential. They are betting on your ability to dominate a category, not just survive in it. To summarize, VCs invest pooled funds from LPs, limited partners. They focus on scalable, high growth ventures. They expect structured governance and exit. Now let's compare the two side by side. Angels typically invest 25K to 500K of their own money, while VCs invest institutional funds, usually 500K to 5 million or more. Here's an example. A fintech founder first raised 100K from two angels to build her MVP. A year later, she closed a 2 million VC round once she hit 20K active users. Angels took the early risk and the VC funded the scale. Understanding these differences helps you frame your outreach. An angel pitch is personal and story driven. A VC pitch is structured and data driven. Both expect clarity, but at very different levels of proof. Let's step back and look at the broader investor mindset. When you think about raising money, flip the perspective for a moment. Step into investors' shoes. Investors are constantly asking themselves four questions. Is there a real market demand? Can this scale? Does the team have the skill and character to pull it off? Lastly, what kind of return might I expect? If you can answer those questions clearly and confidently, You've already differentiated yourself from most founders.